What are performing and non-performing notes? In every note it starts with a borrower. In the purchasing of a property, people often look to the bank to borrow money to buy their home. The document that the borrower signs that promises to repay the loan is referred to as a note. After this point of origination, the note generally goes in one of two directions. One direction is as a performing note, which means the monthly payments on the loan are made consistently, thus providing the bank or note investor with a passive cash flow. On the other hand, the note can become a non-performing note, which means the borrower fails to pay their monthly mortgage payments, also known as a default. It is common that these performing notes are sold between financial institutions. In fact, if you have signed a mortgage of your own, you most likely received a transfer letter after buying your home. Performing notes are a great way to receive passive and consistent cash flow for the bank and investors, without having to worry about tenants, maintenance, contractors and many other responsibilities if it were a rental property. You can typically get these performing notes for 80% to 100% of the loan balance, which is also referred to as the unpaid principal balance. When a borrower fails to repay for 90 days or more, the note is considered non-performing. As a non-performing note, the lender has a lien on the property through the mortgage and can foreclose on the property to redeem the capital. Banks and lending institutions don't want to spend the time or their resources to work out delinquent borrowers. As a result, they sell these notes at a deep discount to the active note investor that is typically sold at 40% to 70% of the unpaid principal balance.